What is margin trading? So you might have seen different websites offering margin trading in the cryptocurrency space, such as Bitfinex or BitMEX, and you're wondering what exactly that is. So in this short video, I'm trying to explain it as easy as possible, and hopefully you might understand better what margin trading is. So let's get started. So to put it simply, it's basically you put a certain amount of money onto the exchange of your choice. So let's take Bitfinex as an example. And you put your deposit on this exchange. And this deposit is used with the leverage to increase the amount of buying or selling power that you have. So if you put, for example, 10 US dollars onto an account and you have a leverage of 10x, you have a buying or selling power of 100 US dollars. So let's head over to the Bitfinex page. Here they've got a very good example. And on Bitfinex, they have a leverage of 3.3x. So that means your amount times 3.3x is the amount which you can use to sell or buy. Now, in trading, you use two specific terms. You use opening a long position or a short position. And with a long position, you're basically buying into the market and with the expectation that the price goes up. And with a short position, you're selling some coins with the expectation that the price goes down. So for the long position, you gain profit when the price goes up, and the short position, you gain profit when the price goes down. Now, on Bitfinex, you have an initial equity of 30%. And that's because you have to have this amount of money on your account. So it doesn't really matter. You just put, for example, 1,000 US dollars, you put it onto Bitfinex, and with this 30%, these 1,000 US dollars you can use to buy or sell. So you can open a margin position with a value of 3,333.33 US dollars. So now the thing is, what is very important when you open a position is that this initial equity has to always remain 30%. If the value of your position decreases, so for example, you go into a long position and the value of your the price sinks and you are not able to cover these 30%, then your position will be liquidated. So it's very important that you keep that in mind when opening long and short positions, that you place your stops at the correct place. And also another thing, it's much better to have much more equity on your account than you are trading with. What do I mean by that? Well, if you're trading, for example, you want to trade 3,333 US dollars and you want to trade with that, you want to sell or buy Bitcoin as an example. Now, I'd suggest that you don't just have only 1,000 US dollars on your account, but maybe have 3,000 or 6,000 US dollars on your account and then trade with the margin of 3,333. And why is so that you can always keep this initial equity of 30%. So you've got a bit of a gap. You can, it's still important to put your stop loss and at the correct price point to make sure that you don't get liquidated, because you can still get liquidated. Make sure to have good risk ratio, but it's still a security that having more than 1,000 US dollars is a good thing because of this 30% equity minimum that you have to have when trading. Now, let's say you open a long position of 13.33 at 250 US dollars and the price starts dropping. Now, when the net value of your balance reaches 22.5% of the initial value of your margin position, so you start with 30%. However, when it reaches 22.5% of the initial value of the margin position, you will get margin calls. So when the net value of your account falls below 15% of your borrowed funding value, the position will be force liquidated and all your money is lost. Now, there's definitely a lot of risk associated with margin trading, going long, going short. So make sure you know what you're doing. Start reading about trading, technical analysis, and yeah, just keep in mind that it's most of the time much easier to buy and hold on the long term than entering into any type of leverage trading, especially with more than 3.3x. I mean, at the moment, Bitfinex with 3.3x is actually quite moderate way of increasing. You can make a lot of profit with 3.3x leverage. So don't even try and think about going into 100x leverage trading, as their small percentage changes can actually liquidate your whole account. So hopefully you understood the basic gist of what margin trading is. To quickly recap, basically you have your deposit, you have an increased buying or selling power based on the leverage. So what you can do is you take the amount that you would like to risk and then you multiply it by the leverage, and that's how much buying or selling power you have. And the great thing is, one thing I really like about leverage trading is that you can actually also make money during a bear market, because there are not many other options apart from leverage trading to make money in a bear market. And that's one of the main advantages of leverage trading, and that is that you can sell something that you don't have just by putting an initial deposit. So let's say, the thing is with investing, you want to buy low and sell high, but sometimes the price increases so much you didn't have the chance to buy low and sell high. So then what you can do is, in margin trading, is that you can wait until the price is quite high, and you put your deposit, for example, $1,000 on Bitfinex, and then you can sell $3,000 of Bitcoin, which you didn't have to buy at a previous time frame. So I think that's a very good aspect of margin trading. So hopefully you got the gist of this, and if you have any questions, don't hesitate to leave them down below in the comments. I'll gladly answer them for you. So catch you on the next one and have a great day. Bye bye.